Welcome to the discussion. Today we're diving into a fascinating Reddit post titled PLTR. They said the quiet part out loud, DD, a deep dive into Palantir Technologies' stock market strategy. It alleges some pretty bold claims.
Indeed. The post suggests Palantir's actions are far from coincidental, painting a picture of deliberate market manipulation.
The author claims Palantir's entire game plan, from its initial listing to its recent NASDAQ move, centers around manipulating stock market indexes. Is there any merit to this?
That's a strong accusation and requires careful examination. We need to look at the evidence presented.
Exactly. Let's start with the initial direct listing. The post highlights the absence of a lockup period as a key factor.
The direct listing was a crucial decision. A traditional IPO would have involved underwriters, a set price, and shares initially held outside the free float. Palantir's choice allowed immediate trading of insider-held shares.
So this larger initial free float made Palantir almost immediately eligible for index inclusion. The post argues this was intentional, forcing index funds to buy, providing liquidity for insider selling.
That's a core element of the argument. The immediate eligibility for major indexes like the S&P 500, driven by market cap and free float, created a built-in buying pressure. As insiders sold, the effective float increased, further fueling index fund purchases.
It's a compelling narrative, but is it realistic to assume such a calculated strategy?
While proving intent is difficult, the timing and sequence of events are certainly suggestive. The rapid index inclusion and subsequent insider selling raise questions.
The post also points to Palantir's investments in SPACs between 2021 and 2022. They allegedly used this to artificially boost revenue and profitability, paving the way for S&P 500 inclusion.
The SPAC investments are a complex issue. While not illegal, investing in SPACs and then using their funds to purchase the investor's own services certainly blurs the lines. It's a way to potentially inflate revenue figures, though the long-term sustainability of such a model is questionable.
So this wasn't about genuine customer acquisition, but rather a financial maneuver.
It appears to be a short-term boost to meet index inclusion requirements. However, it's important to note that Palantir's profitability in 2024, which led to S&P 500 inclusion, wasn't solely reliant on SPAC investments. Organic growth played a significant role.
Let's move on to the recent NASDAQ listing. The post suggests this is the final piece of the puzzle, positioning Palantir for NASDAQ 100 inclusion.
The timing is indeed suspicious. The NASDAQ 100's weighting system favors mid-tier companies, a position Palantir strategically occupies. This move, coupled with the already high institutional ownership, further supports the theory of index manipulation.
The post highlights the unusually high institutional ownership of Palantir, exceeding that of tech giants like Microsoft and Apple. Is this unusual?
For a company that only went public in late 2020, the level of institutional ownership is indeed striking. It suggests a significant influx of capital, potentially driven by index fund purchases.
The author argues that institutional ownership provides the easiest exit liquidity for insiders. Index funds are predictable buyers, making it easy for insiders to offload shares.
This is a key point. Insiders can sell large quantities of shares into the seemingly bottomless pit of index funds, minimizing market impact. This is a very efficient way to cash out.
The post claims that the recent market cap growth is largely due to index inflows, not fundamental improvements. Is this a fair assessment?
It's difficult to isolate the exact contribution of index inflows to the market cap increase. However, the correlation between index inclusion and stock price rallies is undeniable. It suggests a significant portion of the valuation is driven by index buying rather than underlying business performance.
Given the allegations, what role does the SEC play in all of this? The Reddit post expresses skepticism about the SEC's effectiveness.
Regulatory oversight is crucial in preventing market manipulation. However, the complexity of modern financial markets and the sheer volume of transactions make it challenging for regulators to detect and address all instances of manipulation. The SEC's resources are finite.
The deleted tweet from Alex Moore, a Palantir board member, is presented as further evidence. What are your thoughts on that?
The tweet, even if deleted, is a significant piece of evidence. It reveals a candid admission of the company's strategy, albeit unintentionally. The immediate deletion suggests an attempt to cover up the statement.
The Reddit comment section offers counterarguments. Some argue that Palantir's success is driven by its strong product and government contracts, regardless of index manipulation.
It's important to acknowledge that Palantir does have a valuable product and a strong position in the government and defense sectors. However, this doesn't negate the possibility of market manipulation. The two aren't mutually exclusive.
Another commenter points out that Palantir did have a modified lockup period, albeit shorter than typical IPOs. Does this weaken the argument?
The existence of a lockup period, even a modified one, doesn't invalidate the core argument. The key is the significantly larger free float compared to a traditional IPO, which still facilitated rapid index inclusion and subsequent insider selling.
Several commenters also question the author's lack of a position in KLTR. Is this a valid criticism?
The author's lack of a position is a valid point of contention. It raises questions about the motivations behind the post. However, the analysis itself, regardless of the author's position, still presents compelling evidence that warrants further investigation.
The post repeatedly uses the phrase, gaming the system. Is this an accurate description of Palantir's actions?
Gaming the system is a fair characterization. Palantir appears to have exploited loopholes and utilized legal but ethically questionable strategies to maximize its stock price and facilitate insider selling. It's a gray area, but it raises serious concerns about market integrity.
The post suggests this isn't unique to Palantir, and many other companies might be employing similar tactics.
It's plausible that other companies are engaging in similar strategies. The increasing prevalence of passive investing creates incentives for companies to manipulate index inclusion for their benefit. This highlights a systemic issue within the market.
The core of the argument is the disconnect between Palantir's stock price and its fundamental business performance.
The significant valuation disparity is a major red flag. While Palantir's technology is undoubtedly innovative, its current valuation seems inflated, largely driven by index fund buying and speculative narratives.
The post suggests that this disconnect is unsustainable. What's your perspective?
The sustainability of this disconnect is uncertain. While the current market environment favors growth stocks, a correction is always possible. The reliance on index inflows for valuation is inherently risky.
Given this analysis, what are the investment implications for PLTR? The post's author states they have no position.
The analysis doesn't necessarily advocate for shorting PLTR. The inherent risks associated with shorting a stock detached from fundamentals are significant. However, the analysis does raise serious concerns about the stock's long-term sustainability.
The comment section is filled with a mix of opinions ranging from buy the dip to concerns about a potential market crash.
The diverse opinions reflect the uncertainty surrounding PLTR's future. The stock's price is highly speculative, making it difficult to predict its trajectory.
The discussion extends beyond Palantir. It raises broader questions about market manipulation and the impact of passive investing.
The case of Palantir highlights a systemic issue. The increasing dominance of passive investing creates opportunities for companies to manipulate index inclusion, potentially distorting market valuations and creating risks for investors.
The post concludes that Palantir is giving a masterclass in index manipulation. Is this an overstatement?
Whether it's a masterclass is subjective. However, Palantir's actions demonstrate a sophisticated understanding of how to leverage index funds for its benefit. It's a concerning trend that warrants attention.
The analysis presented in the Reddit post is thorough and thought-provoking. Even if some of the claims are difficult to definitively prove, it raises important questions about corporate strategy, market manipulation, and the role of index funds.
The post serves as a valuable case study, highlighting the potential for manipulation within the current market structure. It encourages a critical examination of corporate actions and the potential consequences of relying solely on index-driven valuations. Further investigation is warranted.
That was a great discussion. Thank you for your insights.